While stocks sold via exchanges need to be compulsorily held in DEMAT format, this is not so for mutual funds. One can buy or sell mutual fund related schemes directly through asset management companies, a bank, a personal financial advisor, or third-party portals. The mandatory things for mutual fund investments are net banking facility bank account and KYC compliance. You do not need DEMAT account compulsorily for mutual fund investments. Do you know you don't need to be rich to start mutual fund investments? Neither do you have to invest in one go. You can go for SIP. Simply invest small portions of amount periodically. The minimum amount to invest is just ₹500. So, what are you waiting for? Start your investment journey today. To have knowledge about mutual funds is always an advantage. But to have little knowledge or no knowledge about mutual funds shouldn't be an obstacle in making investments. Mutual fund is a platform for people to create wealth and achieve their financial goals. If an investor wants to have more information about any mutual fund scheme or its performance, then they have investment advisors or financial advisors to help and assist them in making decisions. Not only you can invest in domestic markets through mutual funds, but you can also explore international markets. If you wish to, you can also invest in international funds and explore the international markets also. KYC is something which you needed only when you start your investments in mutual funds for the first time. Once you're KYC compliant, you do not need KYC for every investment you make in mutual funds. There are three categories in mutual funds. First is equity funds, second debt funds, and third hybrid funds. These all categories varies according to the risk factor. For example, equity funds are risky but provide high returns. Debt funds are lower in risk, and hybrid funds are both mixture of debt and equity, which moderates the risk factor. Mutual funds can be for short term or long term based on the investor's investment horizon and objective. There are different short term funds like liquid funds which have maturity of less than 91 days. Then there are ultra short term bond funds which have a maturity of less than 1 year, while there is short term bond fund which have the maturity range from 1 to 3 years. While equity schemes are more suitable for long term, debt mutual funds are suitable for investors having horizon of short term, that is less than 5 years.